Hello, good afternoon, good morning, or good evening, depending where you are. So welcome to the DC³ conference. My name is Vijay Mori. I work at the ITU, and I'm going to moderate today's session of the DC³ conference on identity and privacy requirements for CBDCs. So the DC³ conference is organized by the Digital Currency Global Initiative, which is a joint collaboration of the International Telecommunication Union and the Future of Digital Currency Initiative at Stanford University. And we have 3 working groups that were established by the ITU under the Digital Currency Global Initiative, which are the Policy and Governance Working Group, Architecture, Interoperability and Use Cases Working Group, and Security and Assurance Working Group. So the Policy and Governance Working Group is the one which is studying the privacy and identity requirements for CBDCs. And Mr. Robin Renwick, who is one of our panelists today, is one of the co-leaders of the privacy work stream in the Policy and Governance Working Group. And he'll be sharing a bit more, about the work that's happening in the privacy work stream in today's session. So in designing central bank digital currencies, central banks face a trade-off, between satisfying legitimate user preferences for privacy and mitigating financial integrity risk. And physical cash, as you know, protects privacy because it is anonymous, but it also can facilitate criminal financial transactions such as money laundering, financing of terrorism, and so on. So there are some features, in particular that define the user experience with cash, and that, trying to incorporate these features together in the digital world makes it an interesting challenge. And that challenge is that if you want to spend your CBDC, the merchant has to verify, where it actually came from, and especially if it comes from a central bank. And to do this, they need to be able to trace the history of the CBDC back to its origins, and validating the history of the token by walking back through all past transactions can reveal some data about how it was spent, which is not like basically a cash sense, in terms of physical cash use. So in today's session, our panelists will shed light on the many dimensions of anonymity and privacy, their implications on CBDC design, and also the potential solutions in terms of technology for addressing these challenges. And before I invite the panelists for their remarks, I would also like to inform the audience that they can put the questions in either the Q&A window on Zoom, and to also use the Pigeonhole facility that is available, so that you can send your feedback or questions on today's session. And when we reach the Q&A session later, I will direct these to the panelists for them to respond. So our panelists for today's session are Mr. Herve Tourpe, who is the Chief Digital Advisor at the International Monetary Fund, Mr. Rodney Garratt, Senior Advisor at the Bank for International Settlements, Mr. Goodell, who is a lecturer at University College London in UK, and Mr. Robin Renwick, Senior Research Analyst at Trilateral Research, and also, as I mentioned, a co-lead of the privacy work stream of the Policy and Governance Working Group in DC³. So now I'd like to invite our first panelists to take the floor. So Mr. Herve Tourpe, who is the Chief Digital Advisor at the IMF, I'd like to give you the floor for your introductory remarks. So Herve, over to you.
Thank you very much, Vijay. I hope you can hear me well. And thank you for the invitation. Let me share my screen and You just tell me if it doesn't work. Otherwise, I assume it is working. And thanks for inviting me specifically to this topic, which is, I think, probably the most important in the next 2 years. It has been widely underestimated so far, included by central banks. So I think it's a good time now to start unpacking what these terms means. What is privacy? What is anonymity? And that's the reason I wanted to share with you a few thoughts. I want to unpack these questions of CBDC, privacy, and the role of identity. So today, this is where we are, right? Central banks, and I just picked this one because it's the most recent one. A couple of weeks ago, the digital euro, the ECB, has issued a statement, repeated a statement, which is, we will design the CBDC to be preserving privacy, right? And the statement was, the digital euro design will ensure privacy of personal data and payment. The ECB, and that's important, will not have information on people's holding, their transaction history, and so on, and that are only accessible to intermediaries. So that is designed to be reassuring, right? In a way, central banks are saying, and it's true for most central banks, by the way, they're all saying they will be preserving, usually what they say is, we'll be preserving anonymity. That's what we hear. Well, that's interesting, because I think as they're moving forward, they realize, well, what are we talking about exactly, right? What is anonymity, and to whose perspective it will be preserved? Here they're saying to the central bank's perspective, it will be preserved. But does it mean that it is preserved to the user's perspective? So this is what my next slide is trying to help understand, right? You have the central bank in the picture for sure. And in the previous statement, in many statements, they are disclosing that they don't want your data. And that's true, they really don't. And they probably will not have your data. But there are 8 actors total in this picture. We've got a payer and a payee. Well, they have a say about what privacy and anonymity means. In between, you've got the commercial bank, but you also probably have also a payment service provider. Think of Google Pay, Apple Pay, and Venmo, and those actors. And then you've got the law enforcement that are put in yellow here because there is no discussion on that. Law enforcement is the law. They have to have access to some data in case they need it. There is no discussion to have there. Well, then is a question of government, right? Some people associate wrongfully central banks with government. It's not the same. The central banks are not the same as the government. But think about it. When a person says, I want anonymity when I pay, do they mean I don't want a central bank to have access? Or do they mean I don't want a government to have access? Well, that's an important question, because if you survey people, you may find they mean the government. But in this picture, it's hard to say whether the government even has access to your, but actually it's when at the end of the day, when central banks make the statement, it will be designed to be anonymous, it doesn't pertain to that part of the discussion. Does the government has access to the data? And then number 8 on that picture, you've got everybody else. Let me also raise this point. The relation between those entities will depend on the countries. But it also depends the culture, right? In some countries, it's possible that a person trusts the central bank more than a commercial bank. And we know that for a fact in some countries. In other countries, it's the opposite, where the commercial banks, because of previous event that had happened, people that stopped trusting them and rather trust the central banks. So there is a culture associated to this concept of privacy. So I think the summary of this slide is privacy, anonymity, yes, but to whose perspective, right? Well, the definition is important too. We keep throwing those terms, anonymity, privacy, confidentiality, as if they were synonyms. They are not. And as a matter of fact, it's hard to find one definitions across the globe where everybody agrees on the definition. But if we have to pick one, I personally use the following, where anonymity means the data about the payer on the payee does not even exist, right? That's what I do with cash. And nobody knows, except if they see my face, of course, and they recognize me. But other than that, the data simply doesn't exist. That's what anonymity means, right? Pseudonymity, of course, this term became popular with Bitcoin. We know what it means. It means that, yes, the owners is not revealed, but the wallet the account itself is known, is registered. It's possibly there's no link between the two, but it's the wallet that is known. Now you start seeing terms such as managed privacy. China, for example, is using that term, or they're using managed anonymity. I think there's a translation issue between anonymity and privacy, but in a sense, it means the central bank would provide some options to the wallet users. Now, privacy, it means the data, it's about the data about the person, right? The data exists, it's there somewhere at the wallet level, at the transaction level, but it's kept secret to themselves, to the data owner. That's what privacy means, or to self-designated third parties, right? I can decide as the owner of the data who can see my data. And finally, the term confidentiality is more about the transaction itself, or the what happened. So the data about the transaction exists, but is accessible on a need-to-know basis. It's important to unpack those terms, right? Because I think the next couple of 18 months, we will need to have a clear definition when we talk about privacy. This is my other important slide. It's the what needs to be protected. We often think of anonymity in the sense of the payer. I'm paying something and I don't want the government, usually that's what it means, right? I don't want the government to know what I just did. At the end of the day, that's what people really mean. Well, we need to unpack that as well, because what needs to be protected, it could be the identity of the payer or the identity of the payee. Maybe the payee has a say as well. Maybe they do not want, for some reason, to be known, right? And the payer may be known, but not the payee, or the other way around. And there may be laws that actually agree or disagree with that ambition. Then you have on the transaction itself, what needs to be protected. Is it the amount? Is it the justification? Is it the time and location and whatever metadata associated to this? There's a real question here. And finally, this concept may be more important for the questions of money laundering and countering the financing of terrorism, the patterns themselves. Well, should this be kept private when we know that patterns can actually reveal some bad behaviors? And if so, what sort of patterns? Is it the frequency? Is it the fact that the payer is using multiple wallets? There are many questions that arise about the what can be protected. And I just finished with some important question on the table, maybe for the rest of the discussions that we're going to have. Some questions that arise, such as, if privacy of one transaction is achieved, could we actually consider liberating the data about the aggregate? We've seen the emergence of the concept of temporary privacy, where the data may be available for a duration of time, for the duration of applying the AML-CFT check, the compliance check. But there's some questions about the financial crime. They don't usually have a status of limitations. Then there is the question of controllable privacy and tier authentication. I think we'll talk about that the different amounts of the transaction may actually unlock different sorts of privacy rights. Would that be sufficient for users? Are there schemes that would be acceptable to the end users? I guess we'll talk about the role also of those new technologies, zero knowledge proofs of over privacy enhancing technologies. What are the trade-offs? Is it ready for prime time? Is it really usable to the new users? And finally, I guess an interesting thing to develop among ourselves is the regulation is what it is today. We have to comply to the regulation. There is no debate to have here. But is it possible that the technology offers new ways for regulator to consider compliance? Is it possible that regulation can change thanks to new sort of technologies? So I'll stop there, Vijay, and happy to discuss further.
Okay, thank you very much, Herve, for laying down the different dimensions of privacy and anonymity, what it means from different perspectives. So now I'll give the floor to our next panelist, Mr. Rodney Garratt, a senior advisor at the Bank for International Settlements, for his introductory remarks.
Great. Can you see the slides all right?
Yes, we can see the slides.
Great, thank you. So thank you for inviting me, and let me just start by saying that anything I say, they're my own views and not necessarily those of the BIS. So I'd like to complement what Herve said by talking a little bit about wholesale CBDCs. So that is CBDCs that might be used by institutions to make payments to each other. They also have privacy requirements, but the general points that I make, I think, are equally applicable to retail CBDC as well. And so I want to talk just a little bit about the way we've been thinking about CBDCs so far. And I want to start by mentioning that existing payment systems generally have, at least at the wholesale level, generally have the privacy requirements that we need. So for example, when a bank wants to make a payment to another bank, this is done through a messaging system that directs people to update accounts. And the people that are in charge of updating those accounts have a valid right to see the data. So there's no real problem with the settlement institution. Think of that as being the Federal Reserve in the case of interbank payments. There's no real problem with them seeing the data. So this system works. And so what we've been doing in the last several years, as we try to incorporate new technologies, in particular distributed ledger technologies, we've been exploring the idea that we can improve these systems. And I was part of a project called Project Jasper that was initiated by the Bank of Canada, Payments Canada, a company called R3, and then a bunch of banks in Canada to try and build a wholesale payment system. So this would be a system using distributed ledger technology that would present a possible alternative to the way we conventionally do things. And so the first phase was built on Ethereum. And when we did that, we were trying to capture some of the reported advantages of DLT, the idea that there's no single point of failure, for example. But ultimately, this implementation was rejected on the grounds that it didn't provide the necessary privacy. These systems inherently, through decentralized validation, in order to have decentralized validation, the validators need to see the data, so these systems are not private. So we moved to an alternative system called Corda, and Corda was an improvement. It improved things on two dimensions. One is it got rid of proof of work, which is really not necessary in closed private wholesale systems. So it replaced that by the role of a notary. The notary could be the central bank. So that prevents double spending. But the verification of transactions, that is, when I receive something from you, I have to make sure what you're giving me is legitimate. That required that I look back and I check the origin of those funds. So I have to check that you got them. I have to see where you got them and where the previous person got them, and so on. And this is something called a backchain problem. And so people have been working on solutions to the backchain problem. So for example, they're exploring the idea of zero knowledge proofs. And so what this figure shows you is that basically a person C has to check that the funds that they're receiving are legitimate. So they need to check the history of those funds. And the idea is that we could replace person C actually seeing those transactions with C seeing a series of zero knowledge proofs that assure that those transactions are legitimate, and that in this case, customer B has the funds that they're giving to customer C. And so the point I want to make is that the problem with this approach is that we've taken a system that's inherently not private, and we're trying to retrofit it so that it has privacy. And just to start the conversation today, I'm saying that I think it's important to, in this process, and this, like I said, this also applies at the retail level, to be thinking about the idea of privacy by design. So Herve actually did mention something close to that phrase, but I'm Canadian. I come from the province of Ontario, and the former Information and Privacy Commissioner of Ontario, back in the 90s, articulated these foundational principles of privacy by design. So I won't go through all these, they're not my principles, and you can of course look them up. But the two that I like the most, or just want to highlight before I finish, is the idea of, again, privacy being built, embedded into the design. So privacy being a consideration from the start, not something that we try to retroactively add. And then I'd highlight this non-zero sum idea. positive sum, not zero sum. And what the idea of that is it's the idea that we shouldn't incorporate privacy as a trade-off. That is, we can have sort of scalability, we can have speed, or we can have privacy. We want to trade off one against the other. We really need to include these features as positive aspects of the system without trade-offs. Now, I really mean that at a technical level. I realize, of course, that there's a huge issue in terms of the tension between the privacy of the individual and the social needs to see data for AML reasons, for counter-terrorist financing reasons, and so on. But I often think that that can be achieved through sort of an additional layer that shields certain entities from seeing data that don't need to see it. But we need to maintain the user privacy experience without incurring these trade-offs. So I'll stop there and look forward to talking more as the session progresses.
Okay, thank you very much, Rodney, for your inputs on the privacy aspects regarding wholesale CBDC and maybe also how they could apply to retail CBDC. Now we'll move to the next panelist, Mr. Goodell from UCL, for his introductory remarks. So over to you, Jeff.
Thank you very much, Vijay. Can you hear me?
Yes, we can hear you.
Excellent, very good. So I'm Geoff Goodell. My research at University College London focuses on socio-technical systems. Next slide, please. Slide number 2. And really, our inquiry into this topic started about 6 years ago, and we started with the question of money and the future of money, and what is the future of money? And we really started with this observation about cash. And we observed the decline of cash in the modern marketplace. Consumers are using cash less often for retail payments. An increasing share of retail payments are taking place using debit cards, using third-party payment networks or services, and so on and so forth, and they are using less cash. And this is partly due to the increasing preponderance of internet commerce, people making transactions online and engaging with the economy that way, and also due to an increasing preponderance of brick and mortar shops who are not only closing in lieu of internet commerce, but also are refusing cash. And in many countries around the world, including the UK, this is an increasingly prevalent phenomenon. Now, we understand that cash actually provides consumers with very important affordances, including but not limited to privacy and control. And we understand that the fungibility of cash is in part due to the fact that the cash is not associated with the identity of the party who is spending it. That is fundamental to what cash is. Cash is something that we own. It's something that we possess. Next slide, please. So if we look at the landscape of modern retail payments, we see that cash involves a direct and private interaction between transacting parties. The parties who transact actually own the stuff. The stuff is value intrinsically. The fact that it's fungible and not bound to identity means that we know that this cash has not been marked in a way that will prevent it from being transacted if it's legitimate. And everybody's money is worth the same as everybody else's. It's not linked to this identity of spending parties. Now, if we look at modern retail banking that's taking place using mobile phones and debit cards and the like, we see that these characteristics of cash are fundamentally upended. The transaction is actually between regulated institutions. People are no longer spending money for their ordinary retail transactions that they actually own. Instead, they're spending claims on the balance sheet of institutions instead. And we might think that that's not much of a difference with deposit insurance and so on, but actually it's really important because these institutions become powerful gatekeepers, chaperones, if you will. The transactions can be intermediated, they can be blocked. Yes, these service providers often charge fees, which are often quite onerous. And in addition to this, the consumers are subject to discrimination and profiling on the basis of their identity and the linkages among their transactions. Next slide, please. So you might imagine, based on this, Why does anyone use electronic payments in the modern world, given the fact that the affordances for retail consumers are plainly missing? And indeed, this is about possession and control. We're entering this world where basically these custodians are the alpha and omega of the money that users are spending. And the custodians become gatekeepers, chaperones, as I said. And do we really mean to say that we believe that individuals should not be able to engage with the economy without a chaperone? Now, we're all adults here, and I like to think that we design socio-technical systems for adults. And the reality of the modern payments landscape is making a fundamental change to the relationships among individuals, businesses, and the state. Now, Herve mentioned that regulation is not up for debate. Now, I disagree with that. I take issue with this idea that regulation is not up for debate. Regulation is the product of governments, which hopefully is the product of us. And indeed, as experts in these areas, it is our job to inform regulators and the broader public about the nuances of the socio-technical systems that underpin the technology and policy that upon which modern payments rely, and the impact of changes to technology and policy on these socio-technical systems. Next slide, please. So when we think about this, we have these questions about privacy and control for users. And yes, we can design digital currency to deliver privacy and control for users, but it depends. Of course, the CBDC or digital currency in general, whether they deliver privacy and control depends upon their design. Now, I would like to suggest that a good design for central bank digital currency will provide a centrally issued electronic token with an issuer that is trusted, just as we have with cash. We start by recognizing that cash is a socio-technical system with its features that have evolved over centuries for a reason. And we imagine that clearing and settlement should be done by independent private sector actors because that's how it's always been done. And that's how it is done with cash implicitly. And it's not as if to say that the central bank needs to be involved in transactions. Just because they issue currency doesn't mean that they run a transaction processing system. And finally, as we described earlier, we must protect consumers from profiling through privacy by design. And that means that in the general case, the payers should be anonymous. Now, that's not to say that there could not be certain kinds of payments that regulators will require as a requirement for the recipients, the providers of a business service, for example, to collect additional information from the payers. But that's not to say that the payment infrastructure must itself collect the payments. And unfortunately, in the modern retail payment landscape, this is de facto a requirement. And certain groups such as Financial Action Task Force and others have encouraged the development of implicit requirements like this. Next slide, please. So what does this mean? Well, this means that we need to move away from this paradigm of everything being linked to accounts. And by the way, the term wallet is used and has been thrown around in this world to refer to something that isn't really a wallet. Like when I think about a wallet, I think about something that holds my cash, something that I purchased perhaps, for a couple of pounds at the store somewhere. Unfortunately, there are some providers of services who use the term wallet to describe their custodial offerings, which are really just accounts that happen to hold certain data. And that's not the same as a wallet. And accounts are fundamentally linked to the identity of the beneficial owner. And this is part of the problem here. If we want to actually have tokens that are under the control and possession of the users, they must not be linked to accounts that are identifiable. And that means that they must not be linked to digital wallets that are identifiable, whether they are non-custodial or custodial. They can't be issued. They can't have forced registration. They can't rely upon trusted computing to make remote attestations about the validity of this wallet. So if we're thinking about using EU EI-2 identity wallets for this purpose, think again. Next slide, please. Now, private by design for consumers, does that mean that we need transactions to take place in the dark, the way they do with a system like Zcash or Monero? Well, not necessarily. The problem with the problem with regulation and privacy is not about the existence of AML KYC. It's not about banks collecting AML KYC information for users as a prerequisite for opening accounts. It's about registering the transactions into that account to associate the individuals with their spending habits. The risk of profiling to consumers is not about being AML KYC checked when they open their accounts or even when they receive money, but it's about knowing how consumers spend their money. And for consumers to truly own, they must be able to spend freely without risk or fear of having their spending habits be exposed. Why is it that I go to a coffee shop and they ask me for ID? Coffee shops that refuse cash are implicitly asking me for ID in order to enter the coffee shop and recording the time and location of my existence for all time. That's a real problem for consumers and for consumer rights. Now, we can use privacy-enhancing technologies such as blind signatures, which have been around for 40 years and are absolutely established technology. And also zero-knowledge proofs indeed can be used, although as I think someone said earlier, zero-knowledge proofs might have certain additional technical restrictions. The libraries might not be as well established. But to be honest with you, that should not be a reason for rejecting these technologies as essential. We have to act now. This is something that's really important, because ultimately, whether or not digital currency becomes the de facto mechanism for people to transact, the world of retail consumer payments is changing. And if cash disappears, this is a problem for central banks for many reasons. And it's a problem for consumers for many reasons. Next slide, please. Now, we have many different possible system designs: centralized, decentralized, transparent, private. There are lots of options here, and there are lots of systems that fall into different categories in these options. Now, we can talk about privacy-enhancing systems that have a decentralized flavor. There are a few that exist today, but they are not really institutional systems at this time. Now, that's not to say that we cannot build institutional systems for this purpose, and we can. Next slide, please. So distributed ledgers can support payments in a variety of different ways: account-like transactions like Ethereum, or token-like transactions like UTXO systems, or we could actually have oblivious transfer using oblivious tokens. And a system that my group is working on and has developed over the past 5 years does exactly this. And happy to talk about this at greater length. Next slide, please. And our approach to this system does combine blind signatures for privacy by design to unlink the payers from their habits, forcibly unlink, which is to say that nobody can figure out who the spender was unless the spender explicitly agrees to provide that information. And distributed ledgers allow institutional trust because we have an immutable record. And these assets that we've been using, unforgeable stateful oblivious assets that track their history with privacy by design, with proofs of provenance, can allow the system to scale, unlike most modern cryptocurrency systems. Next slide, please. So that's it. And I want to close by suggesting that actually privacy by design is not at odds with legitimate regulation. It turns out that AML KYC for the recipients of money for the purpose of collecting taxes, protecting consumers from fraud, or knowing who has received money is not incompatible with protecting consumers from the possibility of being profiled on the basis of their spending habits. Thank you.
Thank you very much, Jeff, for going a bit over some of the technology options for privacy by design, and also, addressing a bit some of the challenges that were mentioned earlier. So now we'll move to the next panelist. And before that, I'd just like to remind our audience, you can also put your questions in the Q&A that you have on Zoom. The Q&A window addressed directly to the panelists, and also on the Pigeonhole. I'd ask maybe that we share again the link of the Pigeonhole in the chat, so we can start having the questions coming in, because we're going to go to the Q&A just after the next panelist. So I'd now like to invite Robin Renwick, Senior Research Analyst at Trilateral Research, for his introductory remarks.
Thank you for the introduction, Vijay, and hello everyone. I think from my perspective, we'd be well advised to begin with a bird's eye view. So in 2008, society was gifted anonymously a very specific financial technology called Bitcoin. Bitcoin provided the necessary means to remove centralized control from a digital monetary instrument, and it did it relatively elegantly, and for all intents and purposes can now be described as a robust, secure, decentralized global money system. Governments and civil society have recognized Bitcoin's innovation and for the most part have been relatively supportive of the sector that followed. So we see this through numerous DLT-based initiatives, private and public policy developments, standardization efforts, and the continuing evolution of both legislative and regulatory frameworks. Governments have begun to try and understand how they might be able to evolve their own state-controlled monetary instruments to reap some of the proposed benefits of this new cryptographically leveraged financial technology. Mainly, it seems, at least to me, they want to ensure how they can successfully integrate, collaborate, or compete with the rapidly developing technological space. To be blunt, governments want to ensure they keep pace with the technology that in the past they have maintained strict monopolistic control of. So we arrive at CBDCs. I think it's important to acknowledge that society has yet to determine in a collaborative fashion what the actual goal of a centralized monetary system is. So what is the common or public good that governments seek? Perhaps it's something novel like the eradication of poverty. Perhaps it's a vehicle to reduce inequality. Perhaps it's a vehicle to mobilize personal safety and security. Perhaps it's none of these. Perhaps it's all of them. Perhaps it's something completely different entirely. If we were to ask 100 citizens of the country you're in what the overarching ideology of the country's monetary policy is, how many could tell you? If you were to ask them how their financial system functioned, how decisions were made, who made decisions, how decisions impacted them, would they be able to tell you? I'm quite doubtful that you would get many informed responses. And with all due respect, I'm not even sure if I get consistent answers if we ask the panelists on this panel. But nonetheless, paradigm shifting CBDCs are now on the development agenda and the technology is advancing at a rapid pace. As Vijay mentioned, I'm the co-author of the report on privacy identity, KYC and AML requirements for CBDCs stemming from this DC³ initiative, and it's housed within the Policy and Governance Working Group. My co-author, Dr. Israel Cedillo Lescano, in the report begins by rightfully detailing that we are on the precipice of a strong convergence between financial technology, big data, and data protection, or data sovereignty. And there are implications for this with regards to technology, ethics, and law. So if you read the emerging CBDC literature, I think it's possible to simplistically reduce the whole privacy conversation to a trade-off between consumer requirements, business requirements, and the countering of illicit financial activity and terrorist financing. So I'll talk very briefly about each of these. Consumer requirements. What exactly are these? Have governments across the world asked citizens what characteristics they want to see in their state-backed money? The recent public consultation by the European Commission that Herve quite rightly pointed to suggests that consumers seek key attributes such as privacy and security. It seems pretty straightforward. But has there been an open discussion with the public about whether a CBDC should afford greater monetary policy transparency? Has there been a discussion about whether a CBDC should afford greater accountability with public expenditure? Perhaps greater transparency on the financial activities of legal entities in an effort to fight corruption? Perhaps there should be technologies developed to better monitor money flows between large multinationals, between on and offshore entities, conglomerates, holding companies, etc., and so on. I'm not sure if there's been an open discussion of any of this. There has, however, been a staggering amount of discussion regarding what restrictions to consumer privacy are required to be enacted due to the overt risks and dangers that exist. So business requirements. There is undoubtedly vested interest in the value of payments-related information, and that's detailed in an array of official and semi-official publications on CBDC technology. So just imagine how much profit could be extracted from the market were we able to build, for example, transaction and network graphs with payment-related info. Imagine how much profit could be squeezed from individuals in freely competitive markets if we were able to easily conduct dynamic product pricing, price personalization, and improved targeted advertising based on identity. Companies and emergency fintech startups could easily calculate optimum pricing based on economic and even social profiles. What a fantastic world that would be. Perhaps, though, we should pause. It might be wise to understand the potential implications of this future. So, countering illicit financial activity. Of course, some stakeholders, and fairly weighty ones I might add, have concretely stated that the affordances of cash cannot be replicated in the digital society. It's too dangerous. They argue that incumbent digital payment systems, so what we have now, have been ineffective at mitigating money laundering and terrorist financing. And this is not because of the general ineptitude and in some cases complicitness of entities within the system, but because the technology deployed did not afford surveillance capabilities. And so supposedly we need more surveillance capabilities. Now, I understand that the discussion points that I've raised are reductionist, and I'll take that criticism. Having said that, I have yet to see a fair and proper impact assessment for any specific deployment of a CBDC. I'm not aware of one being published. In Europe, there are legal requirements for data protection impact assessment. This has to be conducted on any emerging or developing technology that poses a high risk to data subjects. Perhaps we could use this DPIA as a starting point to conduct a fair and proper ethical impact assessment, or even a human rights impact assessment, both respected and required methodologies, in my opinion, for transparently conveying the implications of a paradigm shifting technology. Doing that, we might be able to answer the simple question of who is actually standing to benefit from any instantiation of a CBDC, because as it stands, I'm not entirely sure it's the individual. Thank you very much.
Okay, thank you very much, Robin, for your views on this topic as well. So we're now going to go to the panel discussion session and then the questions and answer from the audience. So my first question maybe to Herve, maybe following your intervention, Herve, you talk about the different dimensions on privacy and anonymity and so on. But when we talk about central banks, for example, how are central banks thinking about designing CBDCs for privacy? And we see a lot of those pilot implementations going on. Certainly we cannot have either complete anonymity or complete lack of privacy. So maybe you could tell us a bit how are the central banks maybe going about this whole process.
Yeah, that's an excellent question, because it might come across as if central bank were thinking we provide complete anonymity by design, or the opposite, which is we're going to see everything that's happening, right? Of course, there's a spectrum in between. But there is a question that has been, by the way, a fantastic statement by everybody. And I think we have a lot of things on the table. We pretty much have all the right questions on the table, except one. So far, we've talked about CBDC and identity in comparison to cash for payment. But I think it's important to recognize CBDC and money is more than just payment, right? For example, lending, saving, money can do more than paying. Money can do more than what cash can do as well, right? If you think in terms of saving and getting some interest from your saving accounts, or lending can happen with cash, but there are some features from the digital lending that cash doesn't have. So the question I think that has to be raised is, can we think of CBDC as better than cash? And I think that's important for central banks to consider, because it does offer maybe different options in the what's in it for the users. Think about it. If there are some features that are better than cash, I, as a user, am I willing to provide a little bit more information? That's why I'm using PayPal when I pay someone, or when I pay a website, right? I don't even think about the information that I'm sharing. I'm okay with that because there's something in it that cash doesn't do. I cannot pay Amazon with my cash, at least not in the US. So there's an important question here, and central bank start to recognize that, and some of them, such as Nigeria, even China, are thinking of what they call a tiered authentications, where for small amount of money, say you don't have a bank account, that's the case in Nigeria. If you do not have a bank account, at least you have a cell phone, you have a phone number at least, and that's your identity, and that's all that is asked is your identity, because we also, to a technology viewpoint, you want to avoid double spending, right? There's something that we need to prove that that token has not been used before, and Jeff offered new perspective, new technologies that can achieve that maybe better than just providing a cell phone. But today, that's what Nigeria is thinking. That's what China is thinking. China is going to the next level. At least they state that they go to the next level, which is the telcos cannot share any information about who's behind the phone number. So there's some protections that are evolving here for small amounts. I think in Nigeria it's $100, $120 per day. And then over that limit, there are other limits where you need to provide a little bit more information about yourself, all the way to the large amounts of money. I think Nigeria is $2,500 per day, I believe, in which case you need the full KYC, know your customer, full diligence. So there are shades of gray, but the point I think I'm trying to make is we need to think of CBDC as better than cash for some of the goals that Robin has raised, such as financial inclusion. Financial inclusion is more than payment. It's also about saving, about lending. And how do you do that if you don't provide identity? There might be ways, but it's important. There's a question of usability. The more we use those novel technologies, and I think Jeff talked about non-custodial account. Well, that's the reason why Bitcoin hasn't been used so widely, because it's just unusable to have to manage your own wallet today. Right? I haven't seen a solution that my mom can use to pay in Bitcoin, for example. So if that's the model we have in mind, we have to rethink that. And finally, more importantly, I talked about PayPal. Look, if we want the financial inclusion, the payment service provider to participate to the CBDC payment, and we need them, otherwise there's no CBDC, they need something too. They need a business model. Today, the business model they use is data. So is there a way to think in terms of, so in other words, right, if we think about a completely private, completely confidential, where zero data is shared by the payer, forget about it. There is no business model for the payment service provider. So is there a way to design, and maybe the technology can provide some answers to that, so that there is a business model that can emerge even while respecting privacy and confidentiality?
Okay, thank you very much, Herve. So you mentioned a bit you touch a bit on some of the solutions that were mentioned by Jeff. So maybe the next question for Jeff. You mentioned non-custodial wallets. Maybe if you could explain that a bit just for the audience. And maybe also, maybe to talk a bit about why is it important for people, general public, for example, to be able to purchase and use their own wallets rather than have them be assigned, or registered with an authority. So if you could maybe elaborate a bit on that, that would be great.
Yeah, certainly, and thank you, Vijay, for that, and thank you, Herve, for your comments. So first, to address non-custodial wallets, yes, in fact, non-custodial wallets can be part of a solution that is designed to be extremely scalable and efficient. And indeed, the problem with cryptocurrencies and the straw man of Bitcoin, of course, and cryptocurrencies is that most cryptocurrencies spend most of their time doing two, if not three, performing two, if not three kinds of functions that are fundamentally unnecessary for a payment system. Problem number one is that cryptocurrency systems spend most of their time computationally and storage related on protecting the network from takeover, sometimes called Sybil attack resistance for technical experts in this domain. This idea that because a network is reliant on a permissionless ledger, anybody can take over. So whoever has the resources will capture it. We need to create proofs of work, proofs of stake, these kinds of heavy computation and heavy-handed systems in order to prevent the network itself from failing. So that's problem number one with cryptocurrency systems that we can totally avoid in a CBDC world or a digital currency world with issued stablecoins or similar. Problem number two is that most cryptocurrency systems spend most of their time in token management. Which is to say, there's this idea that the ledger itself needs to manage the state of the tokens and needs to keep track of every individual token or the balances in the case of Ethereum of every individual user and so on. It turns out that that's just not so. We can actually use self-validating tokens to keep track of their own state in a way that is verifiable without actually maintaining state like that on the ledger, and we can actually keep the ledger growing at a constant rate rather than growing at a rate that expands as a function of the number of transactions. And what's important about that is that that implicitly, in addition to token management, a function that most cryptocurrency systems perform is denial of service attack resistance, which is related to getting too many transactions. That's also a waste, as it turns out. We can design, and in fact, my team has designed a system that avoids having denial of service attacks in the ledger, in the permissioned ledger maintenance itself, by actually having the ledger just maintain a set of records that grows at a constant rate rather than a function of the number of transactions. And the final thing, the final problem with cryptocurrency systems, or some in particular, like Ethereum, which ultimately the Ethereum-based tokens or the ERC20 tokens and so on are based on this Ethereum smart contract system. It's predicated upon this fundamental assumption that essentially what people really want is multi-party computation, and the system is designed for multi-party computation in the system, and that's totally not necessary for a system that manages arbitrary tokens. If we can separate token management or balance management from the state of the ledger, we can actually go much farther. And we can talk about why tokens are better than balances at greater length if you like, but tokens are better than balances because we know that with balances, we have to keep track of something that winds up evolving with use, and proving that we've evolved correctly becomes a matter of going back to the source, and you're reliant upon some kind of long-term state and long-term path that can be audited in a way that exposes information. But fundamentally, we can avoid these problems with cryptocurrency. So I think the fact that your grandmother can't use Bitcoin says absolutely nothing about the idea that a non-custodial wallet will or will not be useful in the future. And in fact, non-custodial wallets, I would suggest, are the future. And there are companies that are developing this along with us as well. And we're looking forward to a future in which people can possess and control their own stuff, fundamentally. Now, you also asked the question, Herve, that of whether CBDC is better than cash. I would suggest that CBDC is better than cash in some ways and worse than cash in others. I mean, there are many different kinds of payment mechanisms in the world. There will not be one payment mechanism to rule them all. I think that that's a fundamental sort of fallacy underpinning much of this debate. And in fact, every payment mechanism has its own unique set of costs and risks that are applicable in different circumstances. And CBDC is better in some particular ways, or could be better if it's designed in a manner that's private by design and protects human rights. In particular, it can be transacted at a distance, which means that we can do e-commerce with it. It can be copied in a way that allows us to lose a wallet without losing the value that it contains, which is really important and useful. And it can be transported much more efficiently without the same transportation, handling, and maintenance costs as cash. So I think that there are ways in which CBDC is better. Now that said, cash is better in other ways. I mean, it's not subject to people having devices or being connected to the internet at all or anything like that. I think that this is very important. And it's important for us to recognize that these kinds of technologies will ultimately coexist, and CBDC must not be used as an excuse for snuffing out cash. And I also wanted to address the one question in the panel, which was about can secure enclaves help with privacy and anonymity? I think the answer to that is no. And very briefly, secure elements are unaccountable to their users. Users can't audit them or know what they're doing, for sure. Trusted computing introduces security risks that are particular to digital currency, which is to say that if the paradigm is broken, then people can mint money. I mean, that's a fundamental problem. Relying upon that is quite dangerous. It discourages innovation because fundamentally you're handing control over the hardware to a particular set of hardware fab manufacturers and such. And it distorts the market by privileging its manufacturers, which is related to that. And finally, its certified device is tantamount to transacting with a custodian. It's like a third party in your pocket, which is not what ownership and control is about. Thank you.
Okay, thank you very much, Jeff, for these inputs on your side. So now I'd like to maybe ask a couple of questions about the regulatory challenges that were mentioned. And I think I'll ask these to Rodney and Robin. So Rodney first, maybe why is government action, including maybe provision of CBDC needed to meet user privacy requirements in private systems? So that's a question for you. And maybe for Robin, how should we interpret the manner in which certain national authorities or entities such as the FATF and FinCEN have regulated or proposed to regulate privacy preserving and privacy enhancing technologies deployed into the cryptocurrency and blockchain sector? So both of you can maybe, you can provide your views on these two questions. Maybe Rodney first and then Robin.
Sure, thanks Vijay. So yeah, I'm always interested to talk about what the role is for central banks and or governments in the provision of privacy, especially with regards to the idea of CBDC. And I'd start just by saying that central banks have a mandate, and their mandate is to provide safe, efficient, and accessible payments. And so their actions are designed to meet those objectives. And when should the government step in? The government should step in if there's a reason why the private sector isn't meeting the objectives in a satisfactory way. And so there are really two ways that we could think that this need for sort of government intervention might come about. One is an efficiency idea, the idea that somehow markets aren't gaining all the gains to trade. And if we think about privacy, this is a situation where that might not be the case. And so when in this world of big data, we can tell a lot about you by looking at you, by the things you post, by the information we collect in other sources. And we can tell when you're a lot like another person. And so I can draw inferences about your payment behavior, spending behavior, your tastes, your willingness to pay by looking at others that are like you. And so when someone fails to protect their privacy optimally, because there are steps you can take to protect your privacy. You don't always have to use a credit card. You can go to the store and pay in cash. That's a hassle. People don't generally want to do it. But when people fail to protect their privacy optimally, that creates an externality on others. Because if I learn about you, I learn about others. And so there's this idea of a privacy externality. And so I have work that discusses this. And what you need to do in a situation like that is you need to reduce the costs of people to protect their privacy so that they protect it optimally. And one way to do that could be through the provision of a CBDC. Another sense in which governments might want to be involved is more redistributional. And this one I think is quite interesting. So there was a movement many years ago that I think is still alive and well, which is called the cypherpunk movement. And Eric Hughes discussed this idea of privacy. And quite interestingly, he points out that privacy is not about secrecy. Privacy is the power to selectively reveal oneself to the world. So it's control over your data. It's not the case that we don't want people to ever see your data. Sometimes economic outcomes are better when they do. But then the issue becomes who gets the benefits from this. So who gets the benefits from revealing the data? And often what the collection of data does is it creates data monopolies who then have market power and can give you, the customer, very little surplus. So there's also a question about whether or not we can do anything to intervene, so to speak, in these markets in order to allow consumers to better monetize their data. And this is another area that I've studied where CBDC might play a role. So I think the reasons for intervention in these markets always, I think, has to be some form of market failure or some need for redistribution. And I think that in achieving their mandates, these are the types of things that governments and central banks are looking at. Thank you.
Okay, thank you, Rodney. Robbie?
Yeah, I can kind of jump off from a few of the things that Rodney talked about. I mean, it is interesting to me when I look at this is that there does seem to be a general risk aversion to allowing privacy by design methods, robust privacy preserving mechanisms to be implemented into decentralized monetary systems. And then on the other hand, we have CBDCs discussing how they might be able to implement systems. And I find that dichotomy very interesting because it's almost as if there is a certain pushback against having privacy preserving mechanisms in peer-to-peer technologies that are decentralized, and yet there is a general acceptance that a centralized or state-backed money wouldn't require privacy preserving mechanisms to be implemented. And I can't quite get my head around that juxtaposition, because we've seen regulators in the UK, which is the FCA, in Japan, South Korea, Australia, and so on, all wish to curtail the use of privacy preserving features in decentralized cryptocurrencies, but also at the same time promote the fact that they wish to implement privacy features into their own CBDCs. And it was interesting as well that Rodney talked about the cypherpunk movement in the 80s. In the 80s, there was also the cryptography wars. And I think what we're starting to see now is something similar, where some entities really want to push back against the deployment of specific mathematical functions into payment systems, or even at worse, maintain strict control of when those mathematical functions can and cannot be used. And to me, I think that that is a little worrying, and I think there needs to be an open discussion about what the potential implications are for that for society. Thank you.
Thank you very much. So now let's look a bit at some of the questions from the audience, which are on the screen, as you can see them. Maybe we'll start with the one that has the most number of votes. So maybe any panelists, if you want to come on, please. The first one, maybe, how do you see the roles of CBDC and stablecoin being divided? And maybe what are the privacy requirements for CBDC from central bank perspectives and pilot implementation? So I don't know who wants to maybe give their views on this.
Yeah, maybe real quick on the first one, CBDC and stablecoin. It's an emerging debate whether CBDC are designed to counteract the risks of stablecoin. And by the way, when we say stablecoin, there are two types of stablecoins come to mind. One are the private sector stablecoins, the one that are not backed by the central bank, such as Libra is now defunct, of course, but that sort of stablecoins, completely private. And then the stablecoins that are emerging where they would be backed by central bank money. So in terms of risks, they are very different animals. And in the second definition, the stablecoins that would be backed by central bank reserved resemble more of a CBDC, in which case you can probably think of it interchangeably, right, in terms of what it does and what the role could be. I'm not very aware of many countries that are considering stablecoin. Well, in the US, the Fed has mentioned many times that is there already a stablecoin there that, if backed by central bank reserve, would play the same role as CBDC. The debate is still ongoing in many of the Fed circles. But in general, if they are backed by the central bank reserve, they are the same type of instruments, so to speak.
Okay.
Yeah.
And maybe Rodney, can I pass you the question on privacy requirements for CBDC from central bank's perspective? Are
Yeah,
there
sure. I mean,
requirements that are being
yeah.
laid out, maybe, I don't know, at the level of BIS or elsewhere?
Well, again, I'm not speaking on behalf of the BIS, but I think it's pretty clear that I guess I go back to the idea that I mentioned earlier about central banks trying to fulfill a mandate. One of the ways that you can interpret much of the work that's being done on CBDCs, and if you look at the speeches by Bank of England, Bank of Canada, many institutions, they highlight the idea of privacy. They're very much aware that this is a requirement, because one way to interpret CBDC is that it's not a change, but that it's trying to preserve the status quo, in the sense that, as others have already mentioned, cash is disappearing. The ability of a consumer to pay privately is therefore disappearing with it. And one thing that the central bank could consider doing is to try to provide an alternative form of cash in digital form that would allow the same levels, or roughly the same levels, of privacy as they had with cash. As I said, that would just be preserving the status quo. So these are the types of things that I think central banks are trying to think about in terms of performing their mandate. And then it gets, I guess, a little more fuzzy when we start talking about that it can be better than cash, and what should some of the other features be. So then people start talking about things like programmability. And I think I would agree with Robin to some extent that sometimes that becomes a little bit one-sided in terms of what can programmability do for us, so to speak. But generally speaking, that is also something that I think central banks are turning away from. The ECB has made that quite clear. So again, I think central banks recognize that there are legitimate reasons for private transactions. Consumers are losing the ability to make private transactions in digital commerce, and that there may be a role for central banks to provide that.
Okay, and maybe along the same line, there's another question. Maybe this one, maybe I'll let you guys decide who wants to intervene on that one. There is a question saying, some say CBDCs are specifically being created to breach privacy and inhibit privacy enhanced or centered crypto. Is there any evidence of this?
Clearly, I mean, the answer is in the questions, right? We've seen those on Twitter, of course, but look who's making those statements. Certainly not the central banks. And in fact, I mean, central bankers and designers are smart people. They know very, very well, better than anybody else, that if it was the case, there is no starting point for a CBDC. It would simply not be adopted, and everybody knows that. So there is a fear out there by a certain category of the ecosystem, which is not the CBDC ecosystem, which is more from the private sector, and it's more fear mongering than anything else, in my opinion.
Okay.
If I may, Vijay, I'd like to follow up on that. Yeah, I agree with Herve on this, and I think that the and I think that it's a bit strange, actually, because really, when you talk to when I've spoken with central bankers about the possibility of working with cryptocurrency experts, and also when I've talked to cryptocurrency experts in groups such as Monero about working with central bankers, it seems that there is a bit of a reluctance among many people in these communities. But the reality is that they're actually solving in many ways the same problem, which is to say that that central banks are providing a public payment infrastructure. That's really their job, and has traditionally been their job. And that job is not really different from this idea of building a privacy enhancing cryptocurrency. It's just a matter of whether this is done institutionally or not. And I'd like to think that we can build systems like this institutionally. And I like to think that the kind of technology that cryptocurrency experts are bringing to bear on these problems can be developed in conjunction with central banks. But ultimately, this is a challenge of bringing together two communities that ought to be really great friends, that I think sometimes have to get over some structural sorts of some historical concerns with working with each other. But I think they will. I'm optimistic of this, and I really do think that with respect to CBDC versus stablecoins, as Herve said, if the question if I have a stable coin, the question if I have a bit of digital currency, when the issuer blows up and fails to satisfy its requirements to pay me back what I'm owed, will the central bank bail me out or not? If the answer is yes, then it's a CBDC. If the answer is no, or if there's a possibility that it's no, then it's not a CBDC, and in fact should and must trade at a discount in a fair market. And that is, and that's, I think, really where the crux of this comes from. There's counterparty risk associated with stablecoins. But that said, one question that's just missing from this debate, and someone mentioned in the chat, was, oh well, Sveriges Riksbank has ruled out this particular kind of digital currency. Well, I'm not sure that that's actually true. I disbelieve it, to be honest. But I think that the question is, will central banks actually take up the mantle of building public payment infrastructure that respects the privacy of individual consumers? And if the answer is that they want to wait and see before the private sector proves it out first, then maybe we will see stable coins first. But that doesn't mean that CBDC won't be forthcoming. Thank you.
Yes.
And just quickly, Vijay, just to add to this, I think a lot of the concern from a lot of angles is technologically driven. So if you look at it,
and Robin, maybe if you can also maybe address, there's this question on whether CBDC is competing with Bitcoin.
Yeah. So as I was saying, yeah, it's technologically driven. So if you look at a lot of the early pilot projects, they were Bitcoin-like or Ethereum-like, or built on systems that borrowed a lot of the technology from those protocols. But if we look at how the cryptocurrency or the decentralized cryptocurrency sector has moved forward, there are some very advanced protocols now that are in not only in development, but in the real world. So things that are driven from CryptoNote protocols. There's Mimblewimble, we have Lantis Spark, even things that are in development like Seraphis, which have hugely advanced the technological space. And perhaps the CBDCs, or the entities involved in developing CBDCs, are just moving a little bit slower. So there's always this concern regarding what technology is going to be deployed. In terms of the competition and cooperation, I think it's probably in everyone's best interest if there is collaboration and cooperation, not only between the two social worlds, but also between the technology, because otherwise you'll just get the potential for the negative consequences of a complete split between the social worlds. The decentralized world will have their monetary system that is completely alienates the state, and the state potentially has their monetary system which completely alienates some parts of society, and that's not a good outcome. So I think collaboration is key to a better outcome.
Yes, thank you very much, Robin. I think we've gone through quite a number of issues on the panel today, but before we end, just a question a bit looking forward, maybe. How do you see, I mean, this is for all panelists, so I'd like each of you maybe to intervene on that. How do you see this situation, around privacy implementations for CBDC evolve in the future, given the different possibilities, mentioned by Jeff today and also by other panelists? Do you think there will be a need for a standard, for clarifying a bit some of these challenges and providing solutions that are giving maybe the right outcomes when it comes to privacy? What's your opinion on this? Who would like to go first?
Happy to take it, BJ. So I think briefly with respect to standards, I think it would be better if there are standards versus not. I don't believe that there will be one global currency or something like that. I mean, ask a central banker whether they want to relinquish control over their monetary policy, and I think we'll very quickly realize that there isn't going to be one central currency in the world. I do think that there are going to be protocols, however, that need to be developed in a way that ideally would allow for interoperability, because people will have software for dealing with these that hopefully they would want to be able to work across borders, even if technically speaking they didn't have to. Certainly individual central banks will or individual stablecoin issuers will use their own technologies. But ultimately, if we really want this to be a full-fledged public payment option that serves the interests of their users, I think that we will have an interest in establishing standards and using those standards to measure and assess the various properties associated with these technologies. And in fact, there are efforts to develop standards in areas related to digital currencies and tokens that are going on in various standards development organizations. And we're certainly eager to really broach the question of what the vocabulary is, so that we can speak the same language, taxonomy, ontology, a reference architecture for digital tokens that doesn't assume that we're starting with the baseline of everything looking like Bitcoin or Ethereum. Basically, we need to take a step back and understand what is possible and begin to work towards an understanding of what we can do. Thank you.
Okay. Anyone else?
Sure, I'll go ahead. So, I mean, I think it's not a specific answer, but people obviously have to figure out, what they want and build it. And that's a process of forming consensus. And I would stress that when we talk about CBDC, especially at the retail level, this is something that most central banks do not have a mandate to issue. Central banks cannot take deposits from individuals, so issuing CBDC would be something akin to that. So this is something that ultimately has to go through government. So and this is occurring in many jurisdictions. So there has to be government debate, and people have to decide exactly what they want, and then of course build it. In terms of the immediate future, my hopes lie on getting it right at the wholesale level. I started off by talking about the idea that we also need some forms of privacy in these systems. When two businesses or two banks make transactions, this can't be seen by other banks. And so we're developing systems that can build in the types of privacy requirements needed there. And again, I think the key is privacy by design, but privacy by design doesn't mean taking a system that was inherently non-private and then trying to add stuff to make it private, but rather we have certain parties that are allowed to see data, such as central banks. In the case of large value payment systems, there's lots of reasons, legitimate reasons that are in the public good, why they see this data. I think we should get it right at the wholesale level, and then we can maybe talk about the private level.
Okay, thank you. Rod, Robin or Herve?
Yeah, maybe real quick to add that there's an emerging conversation about CBDC and its role for cross-border payment. And it's becoming clear that if you're considering cross-border payment, you have to consider standards in the way identity is being managed. Sorry about my dog barking right now. So there's definitely a recognition by central banks that this concept of standardizations of the way identity and the way privacy is managed is an important debate to have. But I think it's simply emerging. So the work being done by the ITU in particular is becoming even more relevant now than it has been in the past. And yeah, it was relevant in the past already.
Yeah. Okay, thank you, Herve.
And yeah, just to jump in, I mean, there's obviously a role for standardization development. I think the one good thing about standardization processes is it gets many people at a table sitting around and discussing what the idealized future is, and I think that's an important process in itself. I would also like to see, and I know it started in the United States, they have Project Hamilton, which is a lot more open development process, and they have a concept of an open CBDC, and I think that is also very beneficial for building trust and transparency in this process as we move forward, and I'd like to see more of them.
Okay, thank you, everyone. I think we've covered quite a lot of ground today during the panel. I'd like to thank all the panelists today for this very entertaining session, and also thank the audience for participating in the panel discussion as well. So I hope you have now a better idea, about some of the privacy challenges and also some of the solutions. Even we seem not to have agreement among different people, among the best way forward. But we all agree that privacy by design maybe is the way forward, but now how in terms of implementation this will happen. Maybe that's something where maybe we need to discuss a bit more around the topic. So with this, ladies and gentlemen, I'd like to thank everyone today for their participation. But before we close the session, I'd like to mention our upcoming session, because DC³ conference is still going on. So our next session will be at 4 p.m. Central European time. And this topic will be on technical standards for interoperability. And this will be followed by our keynote speaker, David Chom, the inventor of digital cash and inventor also of digital blind signatures. He'll be making a keynote speech at 5:30 p.m. Central European time. So I hope to see you all there later this afternoon. Thank you very much and have a nice day.
Thank you, everyone.
Thank
Thank you,
all.
Vijay.
Okay.